What is a joint control? And what's the difference between joint operation and joint venture? How to account for these arrangements? Welcome to our video with a summary of IFRS 11 joint arrangements that is a part of our little group accounts and consolidation series. I am Sylvia, the founder of IFRS Box, the website to be if you want to learn IFRS stress-free and like a pro. So don't forget to check ifrsbox.com and browse any articles, videos, courses, quizzes, and many more. We have already seen this scheme in my other videos about the consolidation. It's a summary of all kinds of investments that an investor can make. Investor can buy a subsidiary with a control evidenced by more than 50% share, well, not necessarily, and then full consolidation method is applied. Then investors may invest in an associate where the significant influence is present, or in some joint arrangement, which is joint venture or joint operation. And here the basic criteria is joint control. And then there are any kinds of other investments which are financial instruments. Now, in this video, we'll focus on joint arrangements that are arranged by the standard IFRS 11. The investments in subsidiaries are arranged by IFRS 3 and IFRS 10, all covered by my other videos. And associates and equity method are arranged by the standard IAS 28, investments in associates and joint ventures. So let's focus on IFRS 11. It's a relatively new standard. It was issued in 2011, and all entities must apply it for the period starting 1st January 2013 or later. This standard replaced the old IAS 31, interests in joint ventures, and interpretation SIC 13, non-monetary contributions by ventures. So these two are no longer valid. The objective of IFRS 11 is to establish principles for financial reporting by entities that have an interest in arrangements that are controlled jointly, that is, joint arrangements. In order to meet this objective, IFRS 11 defines joint control and then requires an entity that is a party to joint arrangement to determine the type of joint arrangement in which it is involved, because as you will learn, there are two types. And based on the type, IFRS 11 prescribes the accounting method for entities' interest in the joint arrangement, okay? Well, we have just said that the presence of joint control is the basic criteria for joint arrangement. Well, here the indicator is the equal share in the arrangement, but it's not necessarily the criterion. Joint control is. But what precisely is joint control? Well, joint control is the contractually agreed sharing of control of an arrangement, which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. Well, the first thing you need to assess when deciding whether there is a joint control is collective control of the arrangement. Well, it means that no single party has a control, but all or group of parties are able to control the arrangement collectively. If not, that would mean that, for example, just one party is able to control the arrangement and no other party can veto its decisions, right? Then such an arrangement is not joint arrangement and it's not within the scope of IFRS 11, so you need to apply other standard. If yes, meaning that there is a collective control, then the question is whether decisions about the relevant activities of joint arrangement require unanimous consent of the parties that collectively control the arrangement. If not, for example, when there are three parties and to make relevant decision, two parties are sufficient to agree, then again, such an arrangement is outside the scope of IFRS 11, as joint control requires unanimous consent. If the answer is yes, unanimous consent is required, then there's a joint control and we're dealing with joint arrangement under IFRS 11. When there is a joint control present, then we are in a joint arrangement. Once you identify joint arrangement, you need to classify it correctly in order to apply the correct accounting method. There are two types, joint venture and joint operation. In joint ventures, parties having joint control of joint venture, they are called joint venturers, have rights to the net assets of the arrangement. As opposed to that, in joint operation, parties having joint control of joint operation, they are called joint operators, have rights to the assets and obligations for the liabilities relating to the arrangement. Well, sometimes it's clear what type you're dealing with, as it might be stated in the contract, but sometimes it's not so clear. So how to distinguish these two types and classify your joint arrangement correctly? The classification depends upon the rights and obligations of the parties to the arrangement. Probably the main question in classification is whether the joint arrangement is structured through separate vehicle or not. Well, separate vehicle means simply separately identifiable financial structure, for example, separate company or some other separate entity based on some statute or something like that. If there is a separate vehicle, then the joint arrangement might be joint venture or joint operation, and you would need to carefully consider the legal form of the vehicle, the terms of the contractual arrangement, and also other facts and circumstances when relevant. However, if there is no separate vehicle, then the joint arrangement is clear joint operation. Based on the classification, you need to apply appropriate accounting method for reporting your investment in the financial statements. So how to account for joint arrangements? If you hold an interest in a joint venture, then you need to apply the equity method as described in IAS 28, Investments in Associates and Joint Ventures. IAS 28 is covered by the separate video that you can find in this channel, so if you need to know more about how to apply the equity method, check that out. Joint operator that is involved in a joint operation needs to account separately for its assets, including its share on any assets held jointly, its liabilities, including its share of any liabilities incurred jointly, its revenue from the sale of its share of the output arising from the joint operation, its share of the revenue from the sale of output by the joint operation, and its expenses, including its share of any expenses incurred jointly. So how to account for these items? Well, in line with other appropriate standards. For example, when joint operator provides some machine in the joint operation, the machine is accounted for in line with IAS 16, property, plant, and equipment, just as it would be held by the joint operator in its own business, unless there are some other circumstances. We have just finished our short summary of IFRS 11 joint arrangements, and if you need more or want to improve your IFRS skills, then you're very welcome to check out my IFRS kit and subscribe for free newsletter at ifrsbox.com. Bye bye, and thank you for watching.